vi incontra Hussain Mehdi, Macro e Investment Strategy di HSBC Asset Management. La crescita economica sta rallentando e le attese di carattere inflattivo stanno salendo. Siete preoccupati per quelli che possono essere gli sviluppi futuri sui mercati?
Yeah, so we see the global macro system now in the mid-cycle, which we've labeled as the expansion economy. So typically what that means is we're past the peak of GDP and profits growth. Inflation picks up, and importantly, policy begins to normalize. So for 2022, we expect global growth to slow to more trend-like rates, with the easy wins from reopening having been exhausted, and amid ongoing supply chain disruptions and tighter policy settings, with really the US leading the way in terms of interest rate hikes, while fiscal policy is now acting as a drag on growth as some of the emergency support measures related to the pandemic have been removed. And I think in the near term for Q1, high COVID cases globally and a zero COVID approach in China will also weigh on activity. Nevertheless, we think the current kind of stagflation tone to the macro data should give way to a more positive picture as we head towards Q2. We do expect supply chain problems in the goods sector to improve, while auto prices should stabilize. Service inflation should also cool as reopening pressures dissipate. So overall, I think this means inflation should fall quite quickly, despite some upside risks coming from tight labor markets and stronger wage inflation. Meanwhile, China is engaging in policy easing measures, which should feed through into improved economic conditions there, particularly in the property sector, which has been lagging in performance over the recent months. And we should also remember that households in developed economies are still sitting on very big savings piles, which can be spent, thus supporting the outlook for consumption. So overall, for the main economies, we're looking at GDP growth for the year as a whole to be in a pretty healthy 4 to 5% range, with the UK and China towards the top of that range, while the US, Eurozone and Italy towards the bottom end.
Vi aspettate che la normalizzazione delle politiche monetarie possa avere in qualche modo un impatto sul comportamento dei mercati?
Yeah, so financial markets have had a quite difficult start to this year. Investors have been quite jittery. Volatility has picked up, and equity and government bond markets have sold off. And in relation to your question, a big driver of this market behavior has been essentially investor concerns over tighter monetary policy settings this year. So in terms of equity markets, what has this meant? So higher yields have essentially driven a rotation out of growth stocks where future earning streams are more sensitive to interest rate changes into value parts of the equity market, which typically can benefit from high interest rates, financials being a good example of a sector that has done quite well. So overall, we think tighter monetary policy will contribute to a more difficult year for risky assets like equities in the backdrop of slowing economic growth, higher inflation, and a pickup in volatility. And in this environment, in the context of the very strong returns we've seen over the last 12 to 18 months, that has essentially compressed risk premiums, we do need to be more realistic about what kind of returns can be achieved this year.
E in termini di scelte di investimento, in queste incertezze in cui navigano i mercati, quali sono le vostre indicazioni?
Yeah, so in the near term, we do think volatility in the markets will stay pretty elevated ahead of the Fed policy liftoff, likely Fed policy liftoff in March, as well as, I guess, some of this lingering uncertainty over China's economic cycle. Nevertheless, despite some of those near-term headwinds, we are still confident in the outlook for risky assets over the course of this year. And there's a number of reasons for that. First of all, we think the market's repricing of the Fed rate outlook should be complete by the end of Q1 going into Q2. And by this time, investors should have really digested the consequences of higher US interest rates on the overall risky asset complex. Second, I've already alluded to this, but economic growth should remain pretty robust for the year as a whole. And as I said earlier, that's supported by easing supply chain pressures, falling inflation later in the year, and importantly, policy support in China. So I guess for earnings, this implies a scenario of high single-digit profits growth, which is pretty healthy. And really importantly, on the valuation front, global equities still benefit from attractive relative valuations, and there is still room for risk premiums in the equity space to compress over time. Policy has tightened, but we would argue it's not yet tight or restrictive. And finally, stocks, if you look at history, do traditionally perform well in the earlier part of rate tightening cycles. So overall, we're still, quite confident that stocks should continue to outperform bonds, and in particular, value parts of the equity market, we believe have the most scope to outperform this year.